All these videos, the blogs we write, the collaterals which we make, the analysis which we do, all the public work which we are doing now, we are collating everything into one free course on our website, learn.scientificinvesting.in. And it is available in the form of a free course. So if you register, you have all the content access at one place. So do make best use of it. Hello, investors. Welcome to Scientific Investing. And in this video, we will talk about the Q4 results, the state of the market, and given everybody is talking about either some next round of rally or the big crash coming with election along. So I will try to analyze the overall Q4 FY24 market data, and I will present my views on where the market seems to be going. Now, if you remember 2 months back, we had done a video based on Q3 FY24 results. And 2-3 months back, I had raised my concerns over the performance of especially small cap index and below with a mediocre sales growth rate, but very high PAT growth rate with a fear of margins stopping out given the valuations are on the higher side. I'll just play the important 1 minute of that video here. The growth number for Nifty 50, next 50, mid cap and small cap revises to 6%, 3%, 5%, 6% with overall market 5% sales growth rate. So where we have got 60, 70% return in small cap index, in this quarter, the sales growth rate year over year has been only 5%. The PAT growth rate, even after removing financials, has been 25%, 39%, 24%, and 15%. So we are at a very average sales growth rate and a very healthy PAT growth rate. And in that, if we look, small cap 250 has been the worst performer, both on sales and profitability. And if we go down the small cap in the others category below 500 rank, their performance is equally bad in terms of 4% and sales percent, 7% profit growth rate. So it is the margin improvement which has driven the EPS growth rate. And same thing had happened in Q2, and that is where I started tracking. So let me show you Q2 data. If you look at Q2 FY24 performance, same thing, lower sales growth rate, very high profit growth rate. Now, this is something which is happening from last, I think 3 quarters. And within 1 quarter, we will reach to a base where all this margin improvement beyond a point will be difficult to get. So if you are having this kind of sales growth rate, it will become difficult to extract these kind of margins and profit growth rate. So you saw we had a concern in Q3 that these kind of margin expansions may not be sustainable, and on a mid-single digit sales growth rate, the kind of 20% plus flat growth rate the market is showing, we may not get in future. Now, with that backdrop, let us see how is the market's Q4 FY24 result performance. Standard disclaimers, kindly do not take this analysis as buy or sell recommendation. I do have positions in some of the stocks being discussed. Now, to do this analysis, so far, almost 1400 plus companies have come up with results where market cap is greater than 500. To do a fair analysis, we take those companies where we have a year-over-year data for comparison available. Also, to remove the outliers, we usually get rid of companies which have been loss-making either in the current quarter or 4 quarters back for a fair YOY comparison. And when we filter it out, we have 956 companies where the results are available. And the way we dissect the companies in terms of Nifty 50, Nifty Next 50, we have taken market cap data based on 1st of January. The companies which were ranked 50 or 51, the companies ranked 101, 251, and 501, depending on the market cap. And that is how we have created those bands, so that it may not be exact replica, but 98, 99% you'll see these bands working. So first, we will try to understand how the overall market result it has done, how Nifty 50, Nifty Next 50, small cap index, mid cap index, they have done, and where does it falls when we look at this in terms of valuation. Now, when we look at this data, you can see that all the companies where year-over-year data is available, we have right now 1272 companies. And the same number I have given for Q3, it was 1584, because still maybe 10-15% results are yet to come. And last quarter, Q3 FY24, the year-over-year sales growth rate was 8%. This quarter, this number is 11%. But the big change which has happened, last quarter Q3, we had year-over-year PAT growth rate at 27%, but this quarter Q4, this is down to 13%. And why so? The reason being, what I was highlighting, that this margin expansion may not last long, looks like we have reached to the peak. So if you go in Q3 FY24, the Q3 FY24 PAT margin of the market was 8.7% versus 7.4% in Q3 FY23, which means there is a 1.3% expansion in margin. But now when we are comparing Q4 FY24 to Q4 FY23, we are almost constant at 9.8% versus 10% margin, which means my PAT growth rate will be almost equal to my sales growth rate. And that is why earlier when on 8% of sales growth rate, you had 27% PAT growth rate. This quarter on 11% sales growth rate, we have only 13% PAT growth rate. Now, if we break these numbers by indices, and what we have done here is, the upper table is the whole set of 952 companies with year-over-year data without loss-making companies, ex financials. Why we are taking ex financials? Because in financials, selling is very easy. They say lending is easy, collection is difficult. So I don't want to consider a sales data to show the caliber of the market, and that is why I am removing the ex financials. When we remove the ex financials, it might be okay, but else, if the market corrects or if it goes under sideways, we should not be surprised. I am giving you one more table, and the reason is, one side of argument could be maybe these margins are depressed because of certain few companies. So refinery is one sector which fluctuates these numbers to a great extent, because you have these big companies like Reliance and BPCL, IOCL, and sometimes the results are very, very cyclic. So I thought, okay, let's remove the refineries number also, and then again look at it. So when you remove the refineries, most of the big refineries are in Nifty 100. So that is why you see a big swing on Nifty 50 and Nifty Next 50, where the 13% PAT growth rate goes to 22% and 5% PAT growth rate goes to 25%. But nothing much changes when it comes to mid cap, small cap, and the micro cap space. So the story remains same. So to me, it looks like the best growing index is Nifty, which is having the most attractive valuation relatively. 21.74, I won't call it very costly. I won't call it cheap. It's somewhere in fair zone with almost 13 to 20% growth rate, however you see it. But as you go down the curve, the results are bad and the valuations are frothy. And when you look at the total, I have taken the Nifty 500 index valuation, which is almost around 25. So for a 9% overall growth rate, you are having almost 25 P.
अगर आप सही स्टॉक्स आइडेंटिफाई कर पा रहे हो, लेकिन ये नहीं समझ पा रहे हो कि उन स्टॉक्स को किस प्राइस पे खरीदना है और किस प्राइस पे प्रॉफिट बुक करना है, तो आपको वैल्यूएशन सीखने की जरूरत है। मैं कुमार सौरभ एक फुल टाइम इन्वेस्टर हूं और 2007 से फंडामेंटल और टेक्निकल एनालिसिस प्रैक्टिस कर रहा हूं। इस कोर्स में आप रियल केस स्टडीज के साथ एक कंपनी की इंट्रिंसिक वैल्यू डिटरमाइन करना सीखोगे और उस कंपनी को किस प्राइस पे बाई या सेल करना है, वो आइडियल प्राइस रेंज कैसे कैलकुलेट करते हैं, ये जानना सीखोगे। तो आज ही अपसर्च क्लब ज्वाइन करिए और मेरे साथ वैल्यूएशन सीखिए।
So recently I have recorded this course on upsearch for valuation, and ये course पूरा हिंदी में है, because anyway on my website the courses are in English and there was a demand to record some of these courses in Hindi. So मैंने जाके valuation का जो course है पूरा हिंदी में record किया है, आप जाकर वहाँ देख सकते हो. So this is what the data saying about growth. This is what the data saying about valuation. And in the long run, if you'll see, the growth and the valuations, they talk to each other. In short term, liquidity and all different things can play, but in long run, it's all about growth versus valuation. Now, how the market will play out in next 3-4 quarters, that the results will decide. But if we think in terms of probability, this is not the good situation to be in small cap and below. Usually, how to react in these kind of situations? So let me give you a few more additional data points. Another interesting data point is, if you look at the performance of small cap index, Nifty, along with some other indices, what is evident is the long-term CAGR. When you look at the 20-year CAGR, 10-year CAGR, for most of them, this has been around 15-16%. But if you look at last 5-year and last 3-year CAGR, the standard deviation is very high on the upper side. The 5-year CAGR of small cap is 19% and 3-year CAGR is around 29%. Reversion to mean is a concept which works brilliantly in the market. Now, if we look at this data is return analysis of various indices. And we see most of the indices, the 10 and 20-year return CAGR has been around 15 to 16%. And that is the normal expectation. And the last 4 years of outperformance has contributed to it. Else it was around 12 to 15%. But when you look at the small cap, look at the 5-year CAGR and 3-year CAGR. These numbers are around 19% and 29%. And reversion to mean is a very, very powerful concept. So if the long-term return has to be around 15, 16%, this number might come down to some price correction or time correction. So this again highlights, if you look at this data and what we are looking in terms of results, where Nifty, as I said, might be in fair value zone. The Nifty returns are almost similar to the long-term return, maybe 1 or 2 BPS, 100, 200 BPS higher. But small cap does look uncomfortable. And what is interesting is being totally ignored by the market. Nifty banks, where the last 5 and 3 year of returns may not be highly depressed, but relatively on the fairer side, maybe because of the underperformance of the Kotak Bank and the HDFC banks and all. So this is another way to look at data. And again, the idea is to triangulate it through multiple sources. Third is when you look at the charts, and this is a daily chart. And when you look at the small cap chart, we realize that this high, it is trying to cross again and again, and it is failing resistance. So it is looking like first it tried to cross here, then it failed, then again it tried, it fell resistance. Then this was a false breakout. It tried to break out, did break out again, it went down. Again, this is like looking on the lines of a false breakout. If we go below here, again, it will be another round of false breakout. So this zone is acting as a big congestion zone. And along with the fundamental data I have, along with the kind of historic mean return versus what has happened in last 2-3 years we have. So we need to take all of this into cognizance. Also, when we look at the breadth of the market, so I'm using another chart called percentage of companies above 50-day moving average and below 50-day moving average. If you see in January, since then, the market has been moving a little bit up and down. And here we had almost 87% of the companies above their 50-day EMA. And slowly this number is only coming down, which says the breadth of the market is weak. Even though the index is being maintained by fewer and fewer companies, but the broader participation of the market is missing. And right now we are almost into tie situation where we have 53% of the companies above 50-day moving average, 47% of the companies below 50-day moving average, which is like a head-to-head situation. So all of this highlights the concerns which are there on the small cap index and below. So usually what we do in such a situation, so I can just share how I manage this situation. I manage this situation more at an asset allocation level, more at a tactical level. So if you remember 2-3 months back, I think somewhere in April, we had made a video on gold. So I try to have, and it's not like what I'm doing right now. I have already done this in last 2-3 months when these kind of, challenges were visible. So a little bit in gold, a little bit in silver, but only when it was, the asset class looked right. I will try to, being a small cap investor, I will try to diversify a little bit. So rather than being 100% in small cap, I will reduce my allocation from small cap. I will have some large caps. Maybe the returns might not be great, but one of the priority becomes to manage the volatility in the portfolio. So that is how I try to balance it out. Also, in bull market, we try to get into different kind of stocks, and we don't have the same level of conviction in all the stocks. And worst of the mistakes happen in best of the markets. So these are times when I keep having a relook at portfolio, finding where I don't have conviction, what is not doing well, where there's a valuation froth. Am I in this stock really for 4-5 years, or I am just playing a 1-year game? If I'm playing a 1-year game, I have to be very, very serious about the momentum of the stock, the results, and then try to get rid of all the weaker stock, weaker by conviction, weaker by action, and stay there where I have very, very strong conviction. So these are some of the things I do to manage in these kind of situations. From a long-term perspective, of course, maybe a 10-20% correction happens, time correction happens. We are in one of the best market where, a lot of very good companies are there. And for selective portfolios, anyway, it's a skill game. If market goes down, doesn't mean everybody will do bad or everybody will do good. all it means is the probability of making money becomes difficult and difficult, because when all the 500 companies perform, whatever you pick, you make money. But when 250 out of 500 companies perform, you need to have a better accuracy than 50%. And let's say only 100 of 500 companies are going to perform, then your ability to select those 100 companies or choose your 20 companies in portfolio, how many of those 100 companies constitute in your 20, and how many of your 20 hold rest of the 400, that is going to decide what return the portfolio is making. So when the broader market becomes difficult, the probability to make money becomes difficult, and hence the respective skill sets of picking good companies that comes into foray. That is how we should take all this analysis. It's never about going in 100% cash or being 100% invested. That is how we have to use it. So I hope this gives you a fair idea of, how to make use of this analysis. So if you like our content, do share, do like, do retweet, and I will see you in the next video soon. Thank you.